Welcome back. You're watching The Money Show on ET now. Just before the break, we were in conversation with Rajesh Cheruvu of Validus Wealth talking about, how fixed income can be used to generate maximum returns, even though, of course, we are in a low interest rate environment. Well, here's another interesting product that I'm sure many of you may be already aware of, and that's your generic annuity plans. Did you know that compared to a fixed deposit, these plans actually give a tad bit of a better interest return? So how do they differ? Who should opt for it? We'll also be talking about the interestingly new motor insurance norms, still in a very early stage, but there have been some recommendations coming from the working group which will essentially link any traffic violations to your motor insurance premium. Sajja Praveen Chowdhary, Vice President of PolicyBazaar.com, now joins us on the show. Mr. Chowdhary, many thanks for joining us today on ET Now. To start with, let's understand why, we know for a fact that an annuity plan from a return perspective does score over a fixed deposit. However, from what we understand, an annuity plan is more long-term in nature. How essentially do the specifics differ from, a fixed deposit?
Basically, the annuity plans are majorly going to cater to those customers who are going to retire in the next 1 or 2 years, or who are absolutely about to take retirement. What these plans do is, for example, generally those people who would have retired, they would ideally not want to invest too much into equities, and they would want a consistent income that can flow in every month or every year, kind of, without much of a risk as such. So they tend to put that money either in an FD or a similar sort of a thing. But what we need to understand is, as you've seen, right, the FD rates have come down from about 8-point-ish or 9-point-ish, what they used to be about a few years back, to currently about 5.4%. And then they become taxable also in the hands of the customer. So at 5.4% tax, and again tax upon it, that leaves very less amount in the hands of the customer. And as the economy keeps growing, as you see, right, the interest rates will keep falling down. And if you look at the developed economies today, they're below 2% is what their deposit rates are. And it's expected that over a period of time, probably India also would be in those stages. So if someone is retiring today at the age of 60 years, and they assume that they can put that in FD, and at the age of 70 years, they have a risk which they're not foreseeing today, which is called as reinvestment risk. Basically, that 5.4 today might end up that day at about 4.5%, or even lower than that. And again, tax on over top of it. Whereas what happens in annuity plans is you can lock that money into the annuity plan, and you can have it for, say, till the time you pass away, basically you and your partner alike. Let's assume you have a 10 lakh rupees which you want to put in, you put in that, and then you start getting it about roughly, say, 6.3% interest every on an annual basis. And you can opt to get annuity on a monthly basis as well. Obviously, this is taxable in your hands, but having said that, 5.4% what you get in FD versus a 6.3% what you get here. And the other part is the reinvestment risk goes to zero, because in an annuity plan, basically you're locking it for the next 30, 40 years, kind of. So you're going to get the same 6.3% interest rate till the end. And once, let's assume you pass away, then your partner gets it. And once your partner also passes away, your spouse also passes away, the amount, whatever, 10 lakh rupees, 50 lakh rupees, 1 crore rupees, whatever that you put in that, goes back to your nominee, who might be your kids, or so on and so forth. So this basically, one is, obviously it gives you a higher interest compared to an FD or other investment sort of things that you have right now. Plus, it also takes away the reinvestment risk, which many people don't foresee. That's very large risk when you're speaking about, say after 20 years from now, if the interest rate is about 2% versus a 6.3%, that's a huge amount of difference that you're going to get. And that day, obviously, this is going to be the only income for those retired people, right? So that's how annuity plans look better compared to, say, the regular FDs and others.
Okay. Now, right now we are in this low interest rate environment, because of the COVID crisis. The RBI as well has slashed interest rates. But maybe the cycle will turn, since inflation is also making a comeback. So the RBI may hike interest rates, and, we may once again have FDs rates slowly climbing. It may take some time, but they will slowly climb. However, is it that we always see this margin of, annuities being able to provide that extra 1 to 2.5% yield compared to an FD?
See, that's exactly how to see. One of the what you're referring to is that the FD might slightly go up next year, depending on how the economy might get in, right? What we're not speaking about is 1 year, 2 years. We speak about a long term, right? If someone is going to retire today, they have about next 20, 30 years to take care of. It's not about 1, 2 years. Obviously, as the economy develops and becomes a developed economy, then you can't expect the interest rates to stay at about whatever that 6%, 5% rates, and it's really not possible as such. You look at developed economies and you would understand the same thing, right? They're about less than 2%. There are some countries where obviously rates have gone into negative as well in between. So that's going to be a long-term challenge for people, and that's what we call as reinvestment risk, which if you don't foresee right now, that's something which you will suffer from on a long-term basis. Whereas annuities, that whatever that you're referring to 6.3, 6.1%, whatever it is that is going to be start today, that's going to stay with you for the next 30 years, 40 years. And obviously, that's where it's always going to benefit the customer from a long-term perspective without that risk.
Okay. Fair enough. You mentioned about the tax portion as well for fixed deposit versus annuity. So, I'll move on from that. Now, in the first part of your answer, you spoke about how an annuity is a great product for individuals to buy when they are a couple of years away from retirement. So do you believe that this is a product that should be only purchased then, and maybe, if I'm younger, 25, 30 on, I'd rather explore other asset classes than maybe an annuity? An annuity is something that only, as I'm approaching retirement, should be looked at?
So basically, pure annuity plans, which is what you're referring to, those are the plans that we spoke about, which would suit those who are about to get into retirement, right? But there are other plans which obviously are the retirement plans where you can keep contributing your money and investing till the time you are about to retire, and then move on to annuities, right? So for example, you have these capital guarantee plans, which today, once again, when you compare, not the capital guarantee, but the guaranteed return plans, right? Which obviously would pay you higher returns compared to what a bank FD would pay. Like, for example, the bank FD gives you about 5.4% today, with obviously the returns are going to be taxable in your hands. While a guaranteed return plan would pay you about roughly 5.8% return. And obviously it's non-taxable in your hands. So that's going to be a good amount of savings that's going to come from there. That's one part that the youngsters or the other people can look at. And the second part is about the retirement plans, where once you have this entire lump sum at the last stage, obviously the retirement plans will automatically have an option where you can move that money into annuities, right? So there are multiple options available there, and depending on what one's age is, they can obviously opt for either if they're around the retirement age, they can opt for immediate annuity plans, or the others who can opt for regular plans which can be converted into annuities at the retirement stage.
All right, understood. Just before, just want to get in your word on the working group committee's report as well on motor insurance premium. There's going to be an added component, and the insurance company will now be looking at my driving records. Now, this is something that is so qualitative. What I'm interested in knowing is what's the proposal on turning something so qualitative, quantifying it, and then adding it to my premium. I mean, we have a rough sketch, of course. Nothing is still confirmed by the ministry or by the authorities. But how will it look like? What will this draft look like?
Yeah, I think the working committee has, while you can call it qualitative kind of, I think the working committee has gone in depth and has given a full-fledged proposal in terms of how to quantify it. So they've quantified different kinds of offenses that you would have, the traffic offenses, whether they're minor or major, and they've given certain kind of points to each and every offense, right? So there is obviously a point system which will be in place, and your offense is categorized into one of the categories that are listed there, and accordingly you will get points. And then obviously then there's a second level of quantifying where basically you say, I would have done one major offense versus someone doing 5 minor offenses, and then someone doing having a repeat offense kind of. Obviously, there are rules which are set in that as to how when you're having an offense for the second time, then your points would double up rather than accumulating only 1x the points. And then when you have a third offense, then probably you'll get 3x the points what you would have. And then obviously and adding up all of these points with respect to whether you're minor offenses or major offenses, and then accordingly there is a table which says for this many points this is what the premium is going to be, and you'd be accordingly be charged. So it's very, very clearly quantified by the working group, and it's been put in the proposal as such. So once it comes out, obviously there might be or there can be at times people might have a different view on it as to what can be considered as a minor or a major, or what should attract what kind of points or should not attract what kind of points. And I think IID is also moving in that step itself, where it's opened it for a proposal, the proposal for public, in terms of taking their opinion as to if they have any suggestions or feedback, that they can share it back so that they can consider it and accordingly modify it. And obviously, having said that, everything keeps developing with time, right? I think this is the first step in moving in the right direction, where you're going to also link your premium to even the driver and not only the vehicle, the way it is done in India today. Whereas in Western countries, yes, there are a lot of places where the premium is not linked to the vehicle, but it's also linked to the person who's going to drive the vehicle. And it's just first step. So probably the first cut might go live, next year or whenever it finally gets recommended with the current way it is. But obviously, within as time passes by, there will always be improvements for each and every model, and things would keep changing. But it's very well quantified right now, and it's not a very, very qualitative thing, I would say.
All right. We'll wait for more details and reconnect with Mr. Chowdhary as well once that's out. Thank you so much for joining us.
Driving habits must improve if they haven't already from here on. Okay, well, on that note, we'll take a very short break on the show. Don't go.